This video is presented by Prompton Real Estate Services.
Fixed rates versus variable rates. Which should you choose and how will that affect your purchase? Well, today we're here with Andy, who's been doing mortgages for over
12 years.
12 years to find out everything we need to know about mortgages. All right, Andy, fixed rates versus variable rates. What are they?
Basically, choosing fixed rate is like going to your destination, knowing exactly where you're going. You're gonna take a predictable route, like a highway, so you know you get there on time. Obviously, when you choose a fixed rate, your mortgage payment is the same. Doesn't matter, interest rate goes up and down, you're fully protected. Now, on the other hand, if you choose a variable rate, sort of the scenic route, it could be rain, it could be sunshine. So when sun is shining, it's kind of like interest rate going down. When it's raining, storming, it's kind of like interest rate going up in the last 2 years. So, it could be unpredictable, but if you choose at the right time, chances are you're gonna save money. But if you choose a fixed rate, historically, interest rate are a little bit higher than the variable because you do take a little bit of comfort, so they charge you a little bit of a premium, which kind of offsets it.
Right, so well, these days, how many people are choosing the fixed rate option?
Actually, it's pretty balanced right now because the fixed rate is still a lot of first-time home buyers' choice. I say 80% of the clients, they're first-time home buyer. They just don't understand this, so just go with fixed. Yeah, so it's kind of like a perfect storm right now to kind of consider variable rate because the Bank of Canada rates are coming down, the discount is kind of increasing, so essentially, maybe in about a year's time, you'll see the rates about the same. Anything after that, when the rates are lower, it's just gravy.
So for a lot of people who are choosing or deciding or in between the fixed rate and the variable rate, at what point do you think they should pull the trigger into a variable rate?
It totally depends on your budgeting, your comfort with risk, and obviously having a good mortgage professional to guide you to see and plan what the next 24 months is gonna look like. How can I pay the least amount to the bank, to the lender, right? So having a great mortgage professional is definitely, really valuable.
Right. So I hear often this word refinancing when I hear about interest rates. What does that mean?
Yeah, so refinancing basically is for someone who already own a home and they probably have paid down a significant sum of their, property. So they have got some money on tap. So you can actually come to the bank or go to a mortgage broker. You can ask them to take out the equity, right? So the last 10 years, a lot of people refinance for buying an investment property or buying a second home for their child. People buy investment with it when interest rates are all-time low, right? So as interest rates come down, we're gonna see more and more refinance.
Yeah.
Whether you're a first-time buyer, seasoned investor, or ready to sell, Prompton Real Estate Services is your go-to partner in Vancouver. Their market knowledge, personalized service, and commitment to success set them apart. Take the next step with confidence. Visit Prompton.com and let Prompton Real Estate Services help you achieve your real estate goals.
Well, I heard recently there's a new rule on the 30-year amortization. What is that?
So historically, if you were to purchase a property with less than 20% down payment, we call that a high ratio mortgage. Essentially, they want you to pay it back within 25 years, right? Obviously, with property price going up, affordability is very tough for young people. The government had basically extended amortization from 25 years to 30 years. Not just for first-time home buyers. Now for all buyers, they also increased the threshold of how much you can borrow from an insured mortgage. So previously, you could buy up to $1 million, and then now you can buy up to $1.5 million. So the first $500,000, you can put down 5%. After $500,000 up to $1.5 million, you can pay 10%. But it's not always the greatest thing because now you're paying additional 5 more years of a loan.
Well, one is the extra payment on the extra 5 years. Second, the thing about lower down payments is you're taking out a greater loan, right?
You're deemed to be higher risk. Yeah, when you have less skin in the game. Yeah,
right.
So you have to pay an insurance premium. Yeah, the government doesn't give you anything for free, right? So it could be upwards of 4% of your total mortgage balance.
A lot of people when they go to mortgage broker, you think most of the times the mortgage broker would suggest that variable rate?
I hate to say it, but a lot of mortgage brokers or even mortgage professional at the banks, they would just recommend whatever that's special, whatever's
the highest
popular.
commission. Right?
Yeah, I mean, variable rate, is making me less money, but it's good for my client, I will still promote that.
Is it much harder to qualify for variable rate compared to fixed rate?
In a sense, yes, because currently variable rate, like I said, is in reverse. It is higher today. It doesn't mean that it's gonna stay high. It should come down quickly. But as of today, what I tell my clients is, if you want a variable rate, you would have to pay higher monthly payment, and it will be harder to qualify. But if you do qualify, you do pay more and you pay down more principal, but in the total life of your mortgage, you'll save interest. But if you're a first-time home buyer, your budget is super tight, that's all you have to work with, just go with a fixed rate. Just, you can't take that risk. Just making sure that you can, afford your monthly mortgage payment, that's the key.
So what should people do and what steps should they go to take to qualify for these two types of rates?
Well, first, if you're looking to buy, you should definitely speak to a mortgage professional. Go to your local bank, talk to a mortgage professional, and stop doing just research online. I think a lot of the Gen Z, they do everything online, right? So you can take that information and compare with a mortgage professional and get a pre-approval. You want to enter the market to buy, so when there's more demand on housing, prices should go up. And if it becomes a multiple offer situation and you have no pre-approval, you can't even compete, right?
Second is, how do they increase their chances of a pre-approval?
Exactly. So number one is you gotta look at your credit score, right? So you can log into a lot of credit agency app to see what your credit score is. If you're not at least having 620, then you gotta talk to one of us to see how you can improve your credit score. And that's number one. And number two is your income, right? You gotta be working at least at a stable job, past probation, or if you're self-employed, you already have 2 years of self-employment history. And then you gotta show maybe some tax returns, financial statements, to let the lender know that you can repay the payment. Third thing is actually your affordability. So your income to debt ratio shouldn't be more than 32%. So everything you make a month, no more than 32% should be going to pay your mortgage, your strata fees, your utilities. That way you can pay your mortgage payment and still be able to afford to go out to eat. And
all right, well, Andy, thank you so much for coming on. Where can people find you?
You can find me on my Instagram, andy.lee.mtg. It's short for mortgage. That's it.
I thought it was like an AMG. I thought it's like a car thing. Okay, well, thanks, Andy.
All right, man. Thanks.
Okay.